it's been a pretty weird year in terms of price action in the markets. We've really, for the last 8 or 9 months, have just been in a really choppy sideways consolidation pattern after a really large run-up in 2013 and kind of subsequent light, kind of follow-through light in 2014. And I think a lot of the sort of penance that's being paid now is working off some of the excesses of those moves. There's also been some macro issues that have been weighing on the tape. As a lot of us know, there was Greece, the weakness in the European periphery. There has also been a really large crash in commodities that has been taking place over the last few months, and has gotten really rather steep the last few weeks. And also there's been some concerns about the Fed raising interest rates. I have a new article that's out. It was on Real Money, which is Cramer's website. It's called the, what was the title? It's like, basically it was called Lower for Longer. The Lower for Longer Lifestyle, I believe it was called, and it's really my views on, it's sort of a follow-up to my views on interest rates. I think anyone who's really been following me for, let's say, the last 6 months to a year knows my opinion on where I think interest rates are going. I think that they're going to be in a lower for longer camp, and I've used that hashtag, that lower for longer. My thesis on that is really just that the jobs in the economy are really not very high-quality ones. There aren't that many. Janet Yellen had hinted in her Fed testimony that she sees technology kind of impacting, I guess, jobs, meaning that it's not so much cyclical unemployment that goes with the business cycle, it's more structural. And that can take, believe it or not, decades to repair. I think we've had a really big jump in terms of our technological advances in even the last 7 years that have been that I think the workers haven't really been placed for. You know, in the past, a lot of recessions they usually start, like 1929, the run-up in the crash started with a inventory recession, which just means that it's funny. I've had this argument, it's sort of a circular reference, that it's an inventory recession is under capacity utilization or under consumption. And the truth is that they're both the same side of the same coin. And the technology today has made real-time inventories a lot different than they are. So it's harder for companies, I mean, it can still happen, but it's harder for companies to kind of get caught with tons of inventory when they can manage their supply chains in real time. And a lot of that supply chain management and technological advances have been computers. And you don't really need as many people to produce a car as you may have in the past. You just, a lot of it is automated. And in the last few years, we've had a technological advance also in the oil and fracking industry with horizontal drilling and hydraulic fracturing. And that has fueled and I think eaten up a lot of the weakness in the jobs market with really high-paying jobs. And the subsequent crash in the price of oil and natural gas, which I believe has happened because of a few things, is the Saudis, number one, trying to flood the market and maintain their share and kind of try to squeeze out other weak players. And I think it's also been slowing global growth. I think stubbornly high energy prices have injured the world economy in an immeasurable way. With regard to Asia and with Europe, unlike the United States, they don't really have their own natural resources. They're net importers. We've only really been kind of stepping up our game with this technology in the last few years, and I think that, along with significantly better monetary policy and in policies with regard to FDIC insurance and various other I guess, economic buffers, has done a lot to help our economy. The world is not healthy. So for the Fed to be getting all giddy about, they're not even meeting their inflation targets, which are supposed to be 2%. They just our first quarter, which was supposedly negative, was revised up slightly. It was supposedly negative 0.2. Now it's positive 0.6 with regard to the GDP. But what was kind of missed in there is that they revised down the last 3 years' worth of GDP from 2.3% to 2.1%, and that is a ginormous miss in terms of Fed speak. I mean, it's like missing a field goal by a mile as far as the Fed is concerned. So that puts that stall speed growth 2% this is one of the weakest recoveries we've had after a major recession in forever. And I believe that the Fed is very cognizant of this. I believe that they are not dumb with regard to what's happening with earnings reports. They've been listening. The major factor that all the companies are citing again and again and again are the strong dollar and weak markets. The only durable goods orders that seem to be taking place are Boeing, basically airlines, and that's more of an efficiency and a replacement cycle than it is anything else. So the backdrop with regard to that is not good. I think that's also what's been hurting. Like, if you look at where interest rates are, they are historically low, and the Fed leak, quote unquote, had their end target basically where I had said it would be by 3.5%, but it was significantly longer out than even I had anticipated, which tells me that the Fed is really very nervous. I think they want to prevent the markets from boiling over and pulling a China, going fully parabolic, although they are huge. But the market and all analysts, if you turn on the TVs, keep talking about that there should be multiple expansion, meaning people should be willing to pay more for earnings than they normally under this low interest rate environment than they were during a normalized period. And they are 100% correct. But the big but is that global growth is slowing and that this is not doing good things for earnings. So there is no reason for a premium multiple other than the fact that interest rates are low. So we're kind of caught in this seesaw conundrum. Anyhow, what do we go by here to make determinations whether we should be longer or short stocks, or even flat or neutral? That is a really honest to God fine position. Everyone who's in the money management industry always has to be either fully invested or fully short or whatever. Nah, that isn't how this game really works. It does if you're in the money management industry, where if you lose money and the market's tanking, everyone sort of accepts it. But if you're underperforming, people are pull their money away. I don't believe in that. I've been in the largest cash position in my adult trading career for the last year. I've been playing very tactically and very small. I've been looking for smaller swings. Like if I'm normally looking for 10 or 15 points, I'm happy with 3 to 5 or 7, however long. I'm also using a shorter time frame for those swings to play out. I believe in risk management. I think a lot of people have gotten very lazy and very lax with regard to their levels, and that's why you see things like Disney trading like a biotech stock. People have been complacent, they've been long, they've been strong, they've been buying the dip, they've been talking about this longer term investor BS, playing with the house's money. This is all insanity. If it's your money, if it's in your account, it's in your pocket, it is your money. There is no house money. It is your money or it isn't your money. I've always believed in keeping my money and expanding it, not giving it back. That's gambler talk. And we aren't gamblers here. And if you are, you're not following me, and you better. Anyway, let's get to some levels. So the S&P, I usually use SPY for my proxy here, and the key level is this 210 fulcrum. If we are below there, the market is more vulnerable. If we're above there, we're kind of more on terra firma. I'm willing to have a little bit of give in that level going into the GDP numbers, and we kind of held right above the 61.8 fib of this range. We now have a confirmed, actually it's not really confirmed, but we are starting to make higher lows and lower highs. So what does that mean? That means that the market is compressing. It's in range, and it's going to have a violent break either up for the blow-off, or it's going to fall out of bed and we're going to get the correction. Which one of those is going to happen is anyone's guess. I have my thesis, although I don't really want to bias anybody. Although if you're following me, you know that I'm very cautious here. I've been watching the market internals deteriorate. I've been watching commodities crashing. I've been watching the breadth narrow. I've just not been a huge fan of the market. You're starting to lose some leaders. You know, you have Apple crashing. I wouldn't say crashing. Apple breaking down. Let's just say that. You have ExxonMobil breaking down. You have Disney breaking down. These are really big stocks that matter, and you're not going to carry the market on the back of Fitbit. I'm sorry, it's just not going to happen. And even that gave up the ghost today. By the way, I got a Fitbit this week, so you know the top is in. It's over for Fitbit. I got one. It's over. I'm the last buyer. I'm only half joking. Anyway, the levels are really what's important here because everyone has an opinion, but the truth is in price. Everyone knows I say price is truth. So tomorrow's range, we have a very important jobs number. We had a very big ISM number this week. It was one of the, you're most welcome. It was one of the strongest ISMs I think I've seen in maybe forever, which isn't good for the lower for longer thesis. Although some of the ADP numbers today, the new claims for unemployment are crappy. You have tons of job cuts coming in the energy sector already, more to come, probably more in the banks. Why not? I would say that you'll probably start having some in these tech startups if there's a further correction and crash in companies like Twitter and Yelp. The stalwart in that area is Facebook, by the way. And even Facebook today did not have the most lovely of candle patterns. It was trying to retest the highs. It pulled back, pretty nasty engulfing pattern, although we kind of closed okay over the 20 MA. I've been saying I thought that Facebook had the potential to pull back a little bit further. I would be very excited if it could get back down to 83s or 85s to buy the dip. I don't know that you're going to get there, but 88s are possible. It could also just chop and hang up here if you're a Facebook bear, short against today's high. Very simple. If you're a Facebook bull, you buy over today's high. Again, very simple. Either you buy on momentum over today's high. If you break today's high, which was a really nasty reversal pattern, it's going to fly. If it doesn't get above today's high, then it's probably going to pull back more. Pretty simple. Apple. I didn't finish SPY. Let me finish my SPY analysis before we go that further. Let's keep it real here. So as long as we hold above this 61.8 and let's say 200-day moving average, I think the market is kind of quote-unquote okay. I like it if it's above this 207.84, which I've been saying is a cautionary level. We held it today. We did finish below the upper distribution a little bit of 208.97. Anything below that and between there and 210 makes me a little bit more cautious. Tomorrow's number, that range tomorrow, is going to be, I think, what you can trade against for the rest of the balance of the summer until we get to the September Fed meeting. That range from that Fed meeting, by the way, is going to probably set the pace for the next year. So it's going to be a really very serious meeting. Let's see how that shakes out. But in the interim, a jobs number like this is really key. So tomorrow's high of day and low of day is the range to play against. Anything below the low of day is a short. Anything above the high of day is a long. That is my story, and I'm sticking to it. If the market breaks down, the 207s are key. If we lose 207s, we'll probably see the 206s. 206s was the last range low, but I would say if we snap the pattern, we're probably going to see 204s and maybe 202s fairly quickly. 204 being the range low. If we wind up breaking out and up, I would think we probably see the 212s and maybe even 213s or 14s pretty quickly, believe it or not. We've built up a lot of pressure here, so it can kind of go either way. Forgetting what I think or what you think or what anyone thinks, the market is pricing in a really low move tomorrow, which I don't know if that's going to be correct. The IV is really low. We're only around 13% or so. The VIX closed. Where did the VIX close? VIX closed a little bit strong today, but still rather kind of mundane, 13.77 below all the major moving averages. It did make a fresh low, though, yesterday below the range to 1088. That's about as low as we get. That's about as low as we get with the VIX, and now it's kind of rallying back up. So it wouldn't shock me to see if we have a little bit more of a move into the upper part of the range. I had said yesterday about hedging and using S&P puts or put spreads as some hedges. They were cheap. They're still fairly relatively cheap. Not a bad idea. I would be using probably out in September's. I kind of like those. The 50-day till expiration has a fairly low IV. I think you can buy those relatively cheaply. So that's SPY. IWM is a little bit more concerning. It has been making lower highs and lower lows. And it did close today below that key 120.97 level. It hasn't violated the 119.39. You know, I think if we break there, we're going to be, dare I say it, kissing that 117.37 level. Down in that area, I think, is a good right or right out area for a bounce. But you really want to see the pattern reverse to start getting bullish again. And I really, at this point with IWM, want to see it back over 123.67, which was the last swing high. So that is my thesis with IWM. The Qs, Apple has been weak, and I've been saying it needs to close over 115.07. It has eked it out the last 2 days, I believe. Qs today halted basically right on the 50% fib and the 50-day moving average. I think that the real key for that is to stay over 109.42. Anything below, let's say 109s, because that's the 61.8, the 109.10. Anything below there to me is a little bit more vulnerable, probably to 107s, potentially even back down to retest the 105s. There's a lot of congestion in that range. It bounced once. I don't know how well it's going to bounce again, although we did make a new high since then. Wouldn't shock me to see that kind of get a little bit squeamish if Apple starts kind of breaking down. I see the resistance in Apple now that it didn't hold the 119.75. Anywhere between 119.75 and 122. If it can't get above there, it's going to be pretty ugly for Apple. The 115 is really a key hold. We've been holding in there. A hold there puts those 119s to 122s in play. Although if it bounces there, I'd probably be a GTFO and then kind of see what happens. If Apple does wind up breaking down lower, and I think that it has some potential that it could, this 109, 110 area is going to be key. That was a gap fill around 109.03. The 61.8 in the range is 110.22. It wouldn't shock me to see some type of a bounce there, but there could be a rollover and overshoot depending on how the market is. The old high in Apple from the pre-kind of 30% correction crash was 100.72. Guess what? That coincides perfectly with primary trend. I would be a buyer there in some mucho size, probably selling puts, buying calls, or call spreads, or you name it. Maybe even shares for right or right out type of play. The bad news is if that snaps, there's some pretty quick room down to 95s and maybe even 85s, which is the big 61.8% fib retracement. I wonder how many people are going to want to just buy and hold Apple if that happens. I believe that Apple is a really great technical trading mechanism and should be used as such. Don't fall in love with stocks. They don't love you back. But you can be in love with setups, and that would be my setup. The right or right out at either somewhere between the gap fill and the trend line. If that's a snapperooski, then we will play very aggressively, actually, for a further correction. Because if that happens, the market is toast. So you'll have the market going for you, and you'll have Apple going for you. It'll be like a pretty levered up way to play. If you want to hedge, if you want to play the short game, you could always kind of do the money line trade, I call, for you football bettors, where you could buy the Qs and be short Apple, or vice versa, or whatever. So that's my thinking, but I am really actually more looking for either for a bounce in Apple to short up near the 122s, or for a move down lower to buy the dip for the fourth quarter play. I do think that Apple is going to be okay for the fourth quarter. It's just a matter of kind of getting there, right? So it's got to get through this little malaise and hangover, kind of shake out the chasers. We're getting a little bit extended on the stochastics. I'd love like a really big flush day that got kind of sloppy. We kind of got a little bit of that the last couple days, but I still feel like there needs to be a little bit more puke. I'd love to see it sooner. If it starts bouncing and kind of getting jiggy before the real support, it's not as good. So that is that. So we covered Apple, we covered Facebook, I covered my view on interest rates, I covered the VIX, I covered SPY. I'm just going through the checklist here. Let's talk IBB quickly. So we closed sort of, it's starting to actually look a little head and shoulders-ish, right? A mini little head and shoulders here. Today's bar was really kind of fugly. It was a really large engulfing pattern. It just, ugh. That's the kind of bar that makes you want to kind of vomit. It closed below the 50-day moving average. That is the key with IBB. Anything above the 50 is okay. Anything below is a little bit more iffy. I would say you can be short against today's bar. You know, maybe if you get a 50% bounce back somewhere to like 378, 83-ish, I would be okay with trying a right or right out short there if there's some type of early bounce tomorrow, or maybe even at the 50-day moving average, which is 375-ish. So let's see. Maybe we'll get a little bit of a right or right out short. It's kind of holding these lows. If there's a break of the 369s, I would say that there is room still lower. We'll get there. We'll get to that if it happens during the day. I'll probably tweet out some type of a trade, but it's now coming from a slightly lower high. A break of there would be now lower lows, so we'd be looking to short bounces as opposed to buying the dips. I'm not really super duper bearish on biotech, but the pattern is not looking pretty. This all kind of got started with Biogen, which I remember calling out basically at the top in my weekend videos, saying that this was a kind of a parabolic blow-off. Starting to see that in Netflix, believe it or not. This is starting to get a little bit ridiculous. If they are causing Disney earning problems, guess what? Competition is going to be coming in at some point soon. That is a pretty bullish chart, although the last 2 days have looked a little bit iffy. If you want to be short Netflix, you could do it against like 129 for RoRo. I put on some put spreads today. They're, in retrospect, they're probably, I mean, you'd have to have a really nasty break. Sorry, not put spreads, put ratios on in Netflix. I probably am going to have to do that as it's coming down because the IV is going to beef up, but I will be putting those on in the next couple of weeks to try to catch some down moves. They don't really cost anything the way I do it. I do it for net credits. So I'm about $6 wide. I think I have on the 106, 100 in 8 days. That's probably going to be a zero, but if you keep doing that week after week, eventually you'll catch it and it won't cost you anything to do. So that's just sort of my story in Netflix. Their business model is great. Everyone realizes it at this point. It's hurting Disney earnings. It's absolutely destroying the cable companies with all the bundles. People are cutting the cord, so to speak, and just using Netflix or Apple TV. At some point, these companies are going to change their business model and compete, and they're going to slash and burn in prices. I don't know that it necessarily means people stop using Netflix, but on the margin, it may hurt some of their growth. When you have a stock that's been up like Netflix has, anything like that can be a little bit painful. I still like the stock on corrections, but I'd be more interested in it down near sort of like its 50-day, like somewhere maybe now down near like 98 or 100 for some type of a bounce play. Speaking of 50-day moving averages and bounce plays, let's talk about Palo Alto Networks, PAN-W. I've been fairly bullish on the cyber stocks. I did not like the setup today. Someone asked me on the stream, was it a buy on the 50-day? And I said that I didn't like how it got there. And I don't. It was coming, first of all, from a lower high, which is always a little troubling. And in the past, it has been multiple days, a sort of stair step down to get to that level. Today, it was just a big body engulfing pattern that took out 1, 2, 3, 4, 5, 6, like a couple of weeks worth of trade. And those aren't the ones you want to buy. So I sidestepped that. I saved myself a shellacking. I don't really need to tap myself on the back about it, because if you see a train coming down the tracks and just sidestepping it isn't really anything to write home about. It's just sort of common sense, but I am happy that I was able to save some people some money with that. Oil is what's kind of driving this market. If you take a look at crude, sorry to bounce back and forth between these kind of macros and stuff, but I don't know, in the strange world that is JP, it kind of works. And yeah, I'll sometimes refer to myself in the third person when we get to the end of the week. I just get a little punchy. We had a bit of a hammer today. The thing that was a little interesting about oil today was that it was down, and the oil companies like Exxon and Chevron and some of the MLPs, the rig, these weren't down. They were actually up. I believe that this 45, somewhere between 45s and 42s should catch a bounce. Although, if you start breaking, oil this low has me thinking recession. So I'm a little bit concerned with regard to oil. It wouldn't shock me to see it kind of bounce back up to that 54-ish area, but anything below that 54.24 has me majorly concerned about the economy. It's gotten really sold rather quickly. We'll see if we have a double low, an equal low, a slightly higher low, a lower low. But there should be some bounce in this at some point, considering the violence in which it's come down. But the economy, this is demand destruction. This is what deflation looks like, and Janet Yellen should get on an oil desk and talk to some of those traders, because there is no inflation to be worried about here. Which brings me to Tesla, actually. The problem for Tesla is that it ran ahead of the number. It got sort of close to the critical levels that I had been talking about, getting back up to like those 290s. It kind of pulled back. It's now starting to make lower lows off lower highs. It held some interesting, important levels today, roughly, meaning the 245s by the close. That area, to me, was important. I'm still bullish on Tesla longer term, but it's going to be a little bit hard for electric car companies and solar companies to do well with oil and gasoline crashing. It's just how traders think. That is just how it is. So I think that Tesla will get its mojo back, but I'd be looking for it a little bit lower. The somewhere between 221 and 225 was the breakout, and it's also the 61.8 fib. I'd be looking for row there. If you can get back above today's high, maybe play for the gap fill. That's my thinking. I told everyone in after hours that if it couldn't hold 265s, it was GTFO. So I feel really, really good about Tesla, because you were able to still get out in after hours and get out really rather unscathed. So that to me is Tesla. If it breaks down, then we're looking at 205s. That would really be on a big market crack, but I don't necessarily know if we're going to see that so fast yet. The one thing that is a little bit concerning with Tesla, if you look on a weekly pattern, if you go out, let's say if you look at like a 3-year weekly, I don't even know if you need 3 years, you just need a year or two. It's starting to look like a big head and shoulders pattern. So it is possible that we do wind up and come down and retest into those 180s, believe it or not, and then I don't know if it holds or if it breaks. Maybe the magic is over with Tesla. I mean, we just go by the levels. So I will just say that is, to me, a little bit cautionary. It is roughly on its 50-week moving average, these like 230s. So somewhere between that 221 and here really is where it needs to stop. If it starts going lower, into that 205 area, I think it'll be playable for a bounce, but it's kind of corrected more than it should have, if you know what I mean. So that's Tesla. I do believe that it is going to see higher, and it's going to see that 359 level, the 1.618 Fibonacci extension. I think this is more of a consolidation pattern than the head and shoulders, but I am just telling you what I see, and I am always cognizant of the levels. I am very dynamic and flexible mentally, and I can flip from long to short in the same keystroke. You should be too. It should be automatic. That is Tesla. Coors was one that, honestly, I was a little nervous last night. I went out this thing long. I was short some puts. It sort of had a small rally. It bounced a little bit on coach. I am now flat. I got out of those puts really well. The stock has been down and just disgusting, but I thought a lot of that was factored in. It turned out it was. It was one of the top performers today. There could be some more rally back into like the lower 50s, but if it does, I would be getting out. That's really where the breakdown took place. Between 51s and 53s is to me GTFO, and maybe even a right out for a short. Someone was asking about BABA on here. My thesis on BABA is this. The stock is a piece of crap. It doesn't really behave very well. It just stay away. I just don't really see the need to be involved in BABA at the moment. What I would like to see and would get me involved in BABA again would be for it to take out the recent low, get another one of these flushes just like it did the last time before earnings, and then I would set up and I'd probably play it with a risk-defined call spread to go higher. 68s were the IPO. Maybe BABA sees it. Maybe it doesn't. I mean, nobody thought Twitter could go this low except for me. But it's a really iffy stock, BABA. The way that this stock trades like there's distribution going in there, and it's sizable distribution. This is just amphalotic selling. Anytime the stock rallies, they just sell the bejesus out of it. It feels like insider selling to me. I don't know that that's the case. It could just be institutional. These guys really top-tick the market. China is crashing. There's a lot of concerns about Chinese consumers. Eventually, they'll get it together with BABA. From what level, I don't know. I've played this thing long. I've played it and been stopped out. I've made money. I've lost money. I'm on the sidelines with it. There's just easier ways to make money. Sometimes when I'm in Vegas or in AC or whatever, and I'm playing at a blackjack table, there's some dealers I can beat, and then there's some, I can't. Like, you're sitting at a table. This is the example I give with these types of stocks. If you're sitting at a table and everyone's winning, that's a great table to be at. It's the one where, everyone's excited and happy and playing, and you always stay there until the run ends. There are other tables where I've been sitting and I'm playing, and everyone at the table is losing, and I'm just breaking even or winning a little, losing a little. I don't try to win against. There are sometimes situations you just cannot win. I get up from those tables, I leave, and I look for another table where I know I can win. This one, it's just one of those tables where it's just, eventually the house odds are they're just not stacking up well. There's a ton of distribution and overhead supply. They have that big September lockup coming. I think at this point, just wait till after the September lockup. They probably have an earnings report here. Honestly, the best thing that could happen with this thing is to just flush out and just get this over with. I don't know that that's going to happen. I do believe that they're going to manipulate it back up to 100 at some point. I don't know how they're going to do this, but I just know it's going to happen. I just don't know from what level. I shouldn't say I know it's going to happen. I just feel like it's going to happen. I don't know. There's just so much easier stuff to play this than to play in BABA. LS, I'm not really a gambler, but I'm actually very good at chance games. It's not in my nature; they bore me. That's why I kind of play in Wall Street. But I am a pretty good blackjack, poker, and craps player. I don't love it. I lose my attention, but I have a lot of experience in that. I took a lot of courses on probability and statistics, and I'm actually pretty good at it. Anyway, that's the end of BABA. In terms of discussing it here, we covered cores. Is there anything else that I think we should talk about? Yeah, I mean, if you go back to my weekend video from a couple of weeks ago, I think I cover the commodities and my views on them pretty well. Maybe we get a little bit of a reprieve here in oil. Oh, the sentiment, it does seem a little bit bearish. We're only a little bit off of the highs, right? I think it's just you get a little bit of trader fatigue. Some of the big stocks are cracking, and like I said, you're not going to be able to hold the market on the back of Netflix and Fitbit forever. If Apple's breaking down, if Exxon's breaking down, if Disney's breaking down, these are big stocks that people hold, funds hold. And the breakdown, when you get Disney trading like a biotech stock, you know that you kind of have to respect the price action. It did have a really large bounce today. It still closed below yesterday's low. I would say if you want to play like a Disney, if you get it over today's high of day tomorrow, you can play it for a swing or a day trade for maybe for a gap or a partial gap fill. I'm looking for lower. There's a 61.8 Fibonacci retracement down a little bit lower. On one time frame, it's around the 102s, 25s. I was actually looking today to get in around the 200 MA, around 350. 103.50, but we missed there, so I didn't catch the bounce. I was a little bit ticked about that. But there, on one time frame, it's there. On another time frame, it's a little bit lower, down near the gap fill, around the 94s, 95s. I would be interested to be playing down there in some decent size for a bounce. If we can get down there, and the sharper, the faster, the better. If it's like this, just like chop back and forth, and it gets there, it's the setup isn't as clean. Where will oil bottom? My crystal ball is in the shop, so it's a little bit hard for me to make that prediction. If it does, I will tell you this though: if it doesn't bottom between 42s and 45s here, there could be like a panicky flush down, like maybe like somewhere between, maybe down near 33.20, which was the kind of the crash low. I think that the world demand and supply, given Asia, is very different than it was. We've used up a lot of the time on the stochastics here. I don't know that we're going to see a flush that large, but things often one thing that I'll tell you that from my years of experience is that price can move further, farther, and for longer than seems reasonable or rational in the beginning. Not really out of being rational or reasonable, but out of necessity. Often there's forced selling and forced liquidation, and things get way overdone, and they can do it and stay that way for longer than you can stay solvent. A lot of people buy on margin. A lot of people have size that is outside of their norm. People often don't take the initial loss, which is the kind of, believe it or not, the small loss is the hardest loss to take, because you're still holding out hope. It's just sort of, it's not clear that the theater's on fire yet. It's sort of, it's just a flesh wound, or, I'm only down this or whatnot. When it gets real painful, when stocks start moving in big globs, the pain gets so great that it's just get me the hell out of here. And when you start seeing that, that's when you want to really be liquid and opportunistic to be a buyer in size. Is the Fed guiding the economy well? The Fed doesn't guide the economy. That's the big misnomer. The Fed controls money supply, and when the truth is, if there's a lot of demand for money, the markets or the demand to borrow money goes up, and that naturally raises interest rates. The Fed has been artificially suppressing them, supposedly with QE. The Fed has a lot of control over the near end of the curve, meaning like 3 and maybe even up to 2 year, I would say, treasuries and notes and bills, but they don't have a lot of control over the longer end of the curve, and that longer end of the curve is really not that impressive, which to me means that there is not a lot of money demand. Companies have not been investing in their businesses. They've been buying back stock and paying dividends because they know that that's a better investment than property, plant, and equipment. I think a lot of companies have been very upset with Obamacare. I think they've been very upset with the lack of, with the amount of regulation, the uncertainty that has been coming out of Washington. And I think until there's kind of clarity on that, look what the EPA has done to the oil, gas, and the coal industry. They've decimated these industries. There's been a lot of uncertainty with regard to what the cost of doing business is going to be, And I think that when companies don't have clarity, or visibility is the technical term that people like to use, when you don't have visibility, you're not really apt to invest in your business. You're kind of just going to stick to the status quo. And I think until you get a, again, I think everyone knows my political views. I tend to be more on the air of being a Republican, but I really don't believe until you see a change of administrations you're going to see people investing. I don't think there's. I talk to people all the time. I don't think that there's confidence in the administration and the policy, because there's been a lot of policy change that they're going to want to invest in property, plant, and equipment. And if they're doing it, they're doing it in other countries. Mexico is getting a lot of business. They're opening up that Ford plant. It's just until taxes or corporate taxes in this country are lowered to be competitive with the rest of the world. The corporate tax rate in the United States is the highest in the world right now. And capital flows where it's treated best. Until the U.S. becomes competitive again, I just don't see that happening. Some of the states have been getting aggressive, like Nevada and Arizona, to get in, like to get the Gigafactory, to get the, Apple is building a plant there. These states that have bombed out economies, like New Jersey, just bribed J.P. Morgan with tax incentives to leave New York to go to Jersey. Until you see companies will not hire or invest as long as it doesn't make economic sense to do so. It is not a sense of patriotism that gets people to invest. It has to come from P&L. And until these kind of bozos in Washington get that, we're going to be in this lower for longer lifestyle. By the way, I'm going to post this video on my Twitter. On Twitter. It'll also be on my YouTube channel. Be sure to subscribe. It's Justin Pulitzer Trades. You'll get my weekend review videos. You'll get my Periscope rebroadcast and my special edition videos. If you're not following me, be sure to follow me on Twitter. My handle is @JustinPulitzer. I'm going to wrap it here. So let's see how this employment number comes out tomorrow. I'm going to be tweeting my opinion of it. How I view the employment number. It comes out at around 8:30. So I will be commenting on my view of the quality of the employment number and how I think that plays in for the lower for longer thesis. As of now, I still believe the lower for longer thesis, but if we get a really hot employment number, I need to see how that's gonna look. So we'll discuss that tomorrow. Anyhow, let's have a good trading week. Thank you guys so much for your time. I appreciate the commentary, and cheers.